Hello everyone, welcome to Global Online Platform. I am Rahul sir, your management educator. As you know that we are discussing the crash course on management on most important topics. So here today we are going to discuss the working capital management topic of financial management, which is very much important from exam point of view. Before starting, there is an important information for you that we are providing the UGC NET Management Paper 2 course. If you take this course, you will get full complete video lectures, full syllabus test series, full syllabus notes, and PYQ PDFs, which are given with explanations. Okay, this is going to be a target-based preparation. So the main advantage of this course is paper 2 course. If you take the paper 2 course, you will get the paper 1 totally free. Okay, so here what you have to do, this is the all the content we have added provided for you. There are some free evaluation tests are also available. You can go and attempt and practice, check yourself at what is your preparation level. So what you have to do, you have to download this Global Online app, our official. This is our official logo. This app only you have to download. Later on, after logging in, you will see the home interface. In the home interface, click on the store button and select either you can search in the search box UGC NET Management Paper 2, or you can just select the course which is visible at the 4th number. The fees of this course is 7,000 rupees only, and the validity of this course is 1 year. Okay, so for any queries regarding the course and to join the batch, contact on the given number through WhatsApp. Let's begin today's topic. In today's lecture, we are going to cover what is working capital management, concept of working capital, need of working capital, then what is the importance of working capital, then types, what are the different types, classification chart is there. So we will discuss that, and the most important topic, approaches of working capital. Let's understand what is working capital management. As the name says, working capital management is defined as the current asset minus current liability is a business tool that helps the companies effectively make use of its current assets and maintain sufficient cash flow to meet the short-term goals and obligations. Okay. What is working capital? Basically, in common terms, if anyone asks you, you will say just this current asset minus current liability is working capital. But what is management of working capital? The management of working capital mainly suggests that the difference among the current assets and the common liability should be used effectively as a business tool to fulfill your short-term requirement of current assets and to maintain a cash balance to fulfill your short-term goals and obligations. Okay. So let's understand what is working capital. That was working capital management in here. Now it is working capital. Working capital is that part of firm's capital which is required for the financing the short-term current assets such as current marketable securities, debtors, and inventories. Funds thus invested in the current assets keep revolving fast and are constantly converted into cash, and this cash flow out again in the exchange of another current assets. Working capital is also known as circulating, revolving, or short-term capital. So these are the some names of working capital, that it is also called as revolving capital, then circulating capital, and short-term capital. This you can remember by this mnemonic WCRS. Okay. So working capital, circulating capital, revolving capital, and short-term capital. What does working capital management simply means that the use of current assets and to effectively meet the use of current assets and current liability to as soon as the converted into cash, and so that we can buy a new current asset in exchange for it. Okay. So why working capital is needed in an organization? In an organization, the main reasons behind the requirement of working capitals are to fulfill the short-term debt obligations. The company wants to fulfill its short-term obligations, so it needs the working capital. Then applying for surety bond. Just a second. So we applying for a security bond. We have, if you have to apply for a security bond, you need some working capital because some certain amount is needed to be deposited. So this for surety bond, you need working capital. Then growth and expansion. As you know that the working capital fulfills the purpose of day-to-day operations in an organization. So if an organization wants to grow and to expand its business, it will require the working capital to fulfill its day-to-day requirements. Then emergency preparedness. Emergency preparedness working capital is very much important. Certain amount of a working capital is kept aside because in case of any contingent situation, we can use that working capital to fulfill the necessities at that time. Then seasonal differences. Seasonal differences are very much suppose some products are seasonal and the manufacturing firms use this seasonal working capital to fulfill that, but at the rest of the time when the season is over, they have to maintain a certain amount of working capital to fulfill the monthly or daily requirements like rent, electricity bills. These are not part of working capital. It generally considers the current assets and current liabilities, but some of the current assets are also required when the season is not there. So to meet that requirement, we need working capital. Last one, attracting the investors. If an organization has a good amount of working capital, the investor will attract towards the organization to invest and to buy its share. Okay. So let's discuss the importance of working capital management. Now, in the previous slide, we discussed the need of working capital. Now we're discussing the importance of working capital management. It improves the liquidity and solvency position. A firm's liquidity and solvency improved as per if it manages the working capital in a proper way, then ensures uninterrupted business operation. If you have you are maintaining a proper amount of working capital, managing it properly, then your business operations will flow smoothly. Okay, then increase in profitability and productivity. Your productivity and the productivity of an organization and the profitability improve as per the proper maintenance of working capital. Then goodwill, as the working capital position amount is good, the goodwill in the market will also enhance. Then improves the credit worthiness. Suppose you want a loan, then at that time the financing institutions will give you the loan because they know that you have sufficient amount of working capital, and anytime if they you will repay the loan as per the repay the credit as in the given period of time. Then timely payment of dividends. Timely good working capital helps to pay the helps in the payment of dividends of the preferential. Generally, it is the in case of equity shares, the dividend is not either paid or not paid regularly, but in case of preference shares, a certain amount is required to pay the dividend. Okay. So if the company has some scarcity of funds, this working capital can be used to pay the dividends. Okay. Then helps in financing, facing the contingency. Facing contingency means an undesirable situation occurs in an organization. For suppose the coronavirus consequences were there. Their whole India was locked twice for 2 years, twice for 2 months. So in this case, if we had maintained a proper working capital, we might faced it effectively. Then here comes the classification of the working capital. Classification of working capital is important to understand because generally it is very basic things, but if you if any one conceptual question asked from these types, we can easily able to answer in from the on the basis of the concepts, or we have gross working and net working capital. Then on the basis of time, we have permanent and temporary working capital. Then this permanent working capital is categorized into this regular working capital and reserve working capital. And in case of the temporary variable or variable working capital, here it is categorized as seasonal working capital or special working capital. So remember, you have to remember kisme kya aata hai, because such odd one out questions can also be asked from this classification chart. Then let's see types of working capital. Types of working capital is the we have permanent working capital. It is the minimum working capital required for the producing the predetermined production. Whatever the production is predetermined from the organization side, the minimum working capital which is required to produce it is permanent working capital. Then temporary working capital. Temporary working capital is the additional current assets required for the temporary period, and it is above the permanent working period. Always remember that the amount of the permanent temporary working capital will always be greater than the always be greater as compared to the permanent working capital, because we are using it. Even it is the additional current assets. Additional is word is mentioned na? So you have to remember that these are the additional current assets required for the temporary period. Temporary period is the main keyword to identify the temporary working capital. Okay. Let's understand the gross and net working capital. Gross working capital is the sum of the all the current assets appear in the balance sheet. Whatever current assets company is using, as mentioned, he mentioned in the balance sheet. So the summation of all the current asset will be termed as gross working capital. Current assets are these assets which can be easily convertible into cash. So this we all know that the assets which are easily converted into cash is current assets. Then net working capital concept we discussed. Then it is the difference between the current asset minus current liability. CA minus CL is simply current liabilities are the short-term liabilities. This we know. Then regular working capital. Regular working capital, this is defined as the least amount of capital required by the business firm to fund its day-to-day operations of the business. Example includes the payment of salaries and wages, then overhead expenses for the processing of raw materials. So what is regular working capital? Which is the amount least amount required to fulfill the day-to-day operations of the business. Okay, it is regular working capital. Then seasonal working capital. This refers to the increase in the amount of working capital business needs during the peak season of the year. When the season, when there is peak season of the year, suppose in case of woolen clothes, they have January, November to February period is their peak time. So here they need more working capital. So the this type of working capital, which is being only used in the season, in a particular season, it is called seasonal working capital. A business may never have to borrow fund to meet its working capital needs. So here, in case of seasonal working capital, if it maintains a proper amount of working capital, they will not meet. Don't need to borrow any additional capital as a working capital. Such a working capital specifically meets the demands of the business having a seasonal nature. This working capital is only be used in case of the business to fulfill the requirements of the season. Okay. In case of a business which is of seasonal nature, this seasonal working capital will be used. Let's see reserve working capital. Apart from day-to-day activities, a business may need some amount of capital for unforeseen circumstances. For means contingency events. If any type of contingency event occurs, a business, some amount of funds are kept separately to use at that time. So reserve margin working capital is nothing but the amount of capital kept aside apart from the regular working capital, the amount which is separated from, suppose this is your 10,000 is your regular working capital. and you are keeping rupees 2000 aside. So this is your what? This is your reserve working capital. Okay, I hope the concept is clear. Then special working capital. Supplementary working capital may also be required for the business to undertake the exceptional operations or unforeseen circumstances. Sometimes the supply exceeds in and you have to produce more. Sorry, sometimes the demand exceeds as compared to supply and you have to produce more. At that time you will need some extra working capital. This is termed as the special working capital. Supplementary working capital may also be required to the business to undertake the exceptional of operations. Then the capital required for such circumstances is termed as special working capital. Suppose your production is everyday production is 10,000 units, but if the customers are increasing and they are more, they are getting more for this is can be easily used, mainly used for the seasonal goods, and the customer base of the company increases and then the production turns into 15,000 units per day. So the amount which is required to 5,000 extra to produce the 5,000 extra units, this unit will be funded through the special working capital. Okay. Then here again the summary is given. Gross working capital we have seen, summation of the current assets, working then net working capital, current assets minus current liability. Permanent or fixed working capital, it is the level below which the working capital is never gone. This point keep in mind. In case of permanent working capital is the least level below which the working capital does not go. Okay. It is further divided into regular and reserve, which we have discussed, and temporary working capital, no working capital, or the permanent working, net working capital minus the permanent working capital is the temporary working capital. Okay, temporary working capital is also known as variable working capital. Remember this name. It is further divided into seasonal working capital, special working capital. We have discussed these points. Let's see the main difference between the differences between the gross and net working capital. Net working capital is qualitative in nature. Remember this key differences, because these statements, these differences become base for the statement type questions. Okay, it is qualitative in nature, and the gross working capital is quantitative in nature. Okay, then net working capital indicates the firm's ability to meet its operating expenses and the current liabilities. Okay, then net working capital is mainly used for the to meet its operating expenses and the current liability. Then gross working capital indicates the total amount of available for funding the current assets. As it's the formula tells us it is the summation of current assets, so it is the amount available to fund the for the funding of current asset. Then third point comes, it expresses the current assets minus current liability. The formula based difference is there, and it is indicating the total sum of the current assets. Here CA minus CL, and here sum of CA. Okay. Then fourth point comes, it is suitable for the sole traders and partnership firms. Net working capital is generally used for the sole trader or the entrepreneur person or a partnership firm. Then it is suitable for the companies. Gross working capital is very much required for the companies. Then next point comes that it is useful to find out the true of the financial position. It is useful to find the true position of financial position of the company. What is the true financial position of a company will be told by the net working capital, and it cannot renewal the true financial position. Gross working capital will not indicate the true financial position. Why? Because it is not including the current liability. It is only dealing with the current asset. So it won't be able to tell the financial position of the company. Okay. I hope you understood. Let's, if you want, you can take the screenshot of this chart. So here are the formula mentioned: gross working capital, sum of current assets, and net working capital, current asset minus current liability. Now here comes the most important topic of working capital: approaches of working capital investment. So there are three AMC. AMC is the aggressive, moderate, and conservative. Aggressive working capital, moderate aggressive approach, moderate approach, and conservative approach. These are the three approaches of the finance working capital investment. So let's see aggressive approach to working capital financing. There was the sorry, this word was should be investment financing. This is not investment, this is financing. So these are the approaches of financing of working capital: aggressive, moderate, and conservative. Okay, let's discuss the aggressive approach to working capital financing. The aggressive approach in high risk is the high risk strategy of working capital. It's the high risk strategy of the working capital. Then in this case, when the short-term finances are utilized not only for financing the temporary working capital, but also the reasonable part of permanent working capital. Here what happens, here company is taking a risk. Why? Because they are using the short-term sources of finance to fulfill the requirement of both the temporary and permanent requirement, permanent working capital. Okay, let's see the advantages and disadvantages. The advantages that low financing cost and high profitability. Here the profitability will be high and low financing cost as the short-term sources are used. Then lower carrying and handling cost. The carrying cost and handling cost will also be low. Then highly efficient working capital management. Working capital will be managed efficiently. Okay. The disadvantage. What are the disadvantage of using the aggressive approach? Insolvency risk. As the short-term sources are being used, so there is a huge high risk of insolvency. Then lost opportunities and unexpected shocks. If you use the current short-term sources of finance for financing both the temporary and working capital, then at this time you are taking the huge risk and it may result in undesirable consequences. Okay, I hope this your aggressive approach is clear to you. Let's understand the conservative approach. What does conservative? Conservative are risk-free. Here the company is not like don't prefer to take any risk. Conservative approach is the risk-free strategy of the working capital financing. A company adopting this strategy to maintain the higher level of current assets and therefore the higher working capital. In this case, the working capital is financing. The company is adopting the strategy to maintain higher level of working assets. Here, the more current assets will maintain to a good level there, and therefore it will result in a higher working capital. Then, what is the financing strategy? Financing strategy means long-term sources will be financed. Long-term sources will finance the fixed assets plus permanent working capital plus the part of temporary working capital. Then short-term funds will be financed that the remaining part of the temporary working capital. Whatever temporary part of the temporary working capital is remaining, they will use the long-term sources of finance to both, they will use the short-term finance to fulfill the temporary working capital, and permanent working capital will be used to finance the long-term sources will be used to finance the permanent working capital. In short, I am writing here that the permanent working capital will be financed through long-term. Okay. And the temporary working capital will be financed through short-term. Okay. So this is the whole crux of the long-term, conservatives. Then advantages and disadvantages. The smooth operations with no stoppage. Here you are using the appropriate sources. So here there will not be any interruption in your business. The flow of the business will be smooth. Okay, then no insolvency risk. Here we are using the appropriate measure, so there will be no risk of insolvency. Let's discuss the disadvantage. Disadvantage: higher interest costs. The interest costs are very high. Then funds are kept idle. Then here higher carrying cost. The carrying cost is also high, and the inefficient working capital management. The working capital management is inefficient. Okay, I hope this clear. The interest rate will be high, interest cost will be high because the long term sources are being used, so the interest will be high. Okay, let's discuss the matching approach. Maturity or matching approach suggests that hedge risk by matching the okay, hedge risk is matching the maturities of the assets and liabilities. The permanent current assets are financed through long-term financing, while the temporary current assets are financed through short-term financing. Okay. So here it is said that sorry, this aggressive is little bit different. I told here the about the matching. Here the matching suggests that the short term the main concept which I told at previous slide, the temporary working capital will be financed by short term and the permanent working capital will be financed through long term. Okay, here there is no excess funds. No excess funds are there in case of matching. Now this chart will clear you the difference. Liquidity is high in case of conservative approach. Aggressive approach, liquidity is low. Then in case of hedging or matching, it is balanced. Okay. Then profitability. Profitability is low in case of conservative, and the aggressive approach, it is more because the risks are takers. Only the short-term financing is used to finance both the permanent and temporary working capital. Then hedging, it will be balanced. Okay. Then risk is very low in case of conservatives. Then aggressive approach, the high risks are there, and in case of hedging or matching approach, there will be balanced. Okay. Then asset utilization high in conservative, low in aggressive, and in case of hedging it will be balanced. Then working capital is more requirement is more in case of conservative. In aggressive there is low, and in case of hedging that will be balanced. Okay, now let's see, this chart will clear you. I have added one more chart so that the concept will be clear. In case of matching, matches the maturity of the assets with the maturity of financing. Then in case of aggressive, short-term temporary capital, capital to finance some permanent working capital. And in case of conservatives, uses long-term permanent capital to finance some temporary working capital. In case of conservatism, only the long-term finances will be used to finance both the temporary and permanent capital, working capital. Okay, that's why the interest cost is high. I hope this topic is clear to you. You might have well understood this concept, and any type of questions either from the types or from these approaches, if it comes in exam, you will be able to attempt it accurately. So thank you. Bye. We will meet in next video.